Welcome everybody to our podcast, Generational Gains. This is my father, Greg Herlean, and myself, Carson Herlean. We are here coming to you from California. We are excited to be with you. We come and do these podcasts every so often where we talk about real estate, money, business, how to manage businesses from the perspective of you, who's been in the business for a long time, and me, who's relatively early in the business and in my career. And we love to just share with our viewers who we are, what our businesses are, and share our mistakes and successes that we've experienced so far. And so today, we're going to talk about expenses, how we have a lot of expenses in this life, and they're only getting bigger. And we're trying to talk about ways we can defer them, minimize them, pay less expenses, and save more money, build more wealth through paying less in expenses. And so we want to start with just what are the main expenses we always have? What are the things we're spending money on every month?
Yeah, so just think about that for a second. So what are our major or just what are some bigger expenses? So a mortgage, right?
The house, yep, usually a big payment.
A car payment, probably.
Car.
That's a big one. I mean, just think about your expenses right now. If you bring in whatever it is, $100 or $1,000 or $10,000 a month, what are your main expenses?
Food's a big one.
Food, house,
car, utilities, insurance.
Utilities. Which one do you think is the biggest expense of all of our expenses?
What do you guys think?
What is the biggest expense? We just named some of the top expenses there are.
We're missing one though.
Yep. The number one expense
is taxes.
Taxes. And it's kind of really current today of what's happening. I just read yesterday or this week about Trump and their the politics of kind of the government and what's happened from 2017 to 18. And some of the things that Trump and his administration implemented and the change that went from 2017 to 18 were some pretty good tax breaks, frankly. And I just learned, I probably knew this, but I forgot because it's been so long, since 2018. But come 2026, the end of 2025, his tax code and changes are going to be over. Now, obviously, if he gets reelected in the administration and the government policy changes, then this will be null and void.
Yeah.
But there's a lot of ifs there. So why are we talking about this? The number one expense we all have in life is taxes. What is that? It's anywhere from 25 to 40% of your income is going to this one expense.
Well, and then it's probably even more, because then think about every little thing you get taxed on. Every time you go to the store, every time you do anything, there's a sales tax, a federal tax, a state tax, some sort of tax on everything you do besides just your income tax.
The DMV for your car, your registration. There are taxes everywhere. So if you start to add up all of these taxes, we're talking about probably 50% of your money that you earn goes to taxes.
And I was talking with someone recently, and I don't know if I totally agree with it, but I like what he was saying. He basically said, taxes are immoral. He's like, why do I owe them money? Why should I give them half my paycheck? What do they do for me? It's immoral to pay taxes. And I was like, not how most people think about it, but I kind of get what you're saying. Most people think tax is the first thing you should pay. You're scared to not pay tax, scared to write things off. Like, most people are very on top of paying tax. When he was like, well, what do they do with my money? Why would I give them more money? If I can follow the law and pay less tax, why would I?
Well, I think that last part's the best part. Because I wouldn't probably agree that paying taxes is immoral.
Yeah.
I, in fact, think that there's a good reason to pay taxes. I think that's one of the great things about America is there are a lot of things that our country provides, including, we've all been to countries where the roads are terrible.
Yeah.
And so there's, the list goes on and on, but the point is I think there's a lot of good in taxes, but I think what you just said resonates with me the most right at the end, which is there's a code, and there is a specific code that the IRS has created that allows you and I to avoid or defer paying too much in taxes. Like, for example,
too much. That's a good way to put it.
If I think it would be immoral if if I made $100,000 and 80% went to taxes, which potentially could happen for some people.
Yeah.
But I do think that if you look and you understand, you have a team that helps you, a tax team. It doesn't have to be just a CPA, but individuals that will help you to reduce your tax liability from maybe 40% to 25%. That's a 15% difference. That's if you make $100,000, that's $15,000 a year. If you make $1 million, that's $150,000 just by understanding and having a team that helps understand your taxes. So this is a hot topic, and I just wanted to say one more thing about the article that I read that maybe many of you have forgotten, like I did until I reread this article. But what's about to happen at the end of 2025 is there's a certain class that is going to increase their tax bracket, the largest amount than any other tax bracket. Do you have an idea whose tax bracket is going to be increased the most? Do you think it's the lower class, the middle class, or the higher class?
I'm actually going to guess middle class.
You're right.
Yeah.
Middle class at the end of 2025, going into the year of 2026, the changes are they go from 24% to 33% in federal income tax. That's just in federal income tax. So,
well, the reason Trump put this bill into place 5 years ago was because it was COVID and they needed to help American citizens survive, so they decreased the tax code.
Well,
right, wasn't that it?
Well, no, this actually happened before COVID. This was in 2018.
Really?
So this tax, one of the things that Trump and the administration, and not just Trump, obviously, it was part of his administration, but the government changed were the rules and the tax brackets, and they all changed from 2017 to 18. It went down for everybody. And in certain brackets, it only went down 2 or 3%.
Yeah.
In other brackets, it went down 8 or 9%. Come 2026, middle class is going to go up 9%. Obviously, middle class is where majority of America is.
Yeah.
So that's why I think this subject's kind of near and dear to my heart right now. Is these tax brackets and these laws are changing very soon. And so we now know this is the biggest expense that there is. Now, there is one other expense that's pretty big. And we're going to talk about some things that we can do to maybe bring down that tax, your federal income tax, and prepare for 2026. But before we do so, you had mentioned something. We started talking about taxes. What's the other big tax, or not big tax, but big expense that people have?
Yeah. After tax, I think it's interest. Paying other people money is probably the second biggest expense. If you look at your mortgage and your car payment, well, actually, the actual study is out of 100% of the income that most Americans make, I think it was 20% of that income goes to a car payment. Usually 5 cents of that 20 cents goes to interest. So it's 5% of your income going to interest. Then it said, well, of your mortgage, usually about 30% of your income goes to a mortgage. And of that 30%, 25% of it is interest. So that's 30% of your income after tax that goes to interest, just for your car and your mortgage. If you have credit cards, student loans, that's another 5-10% of interest of your income. So we're saying 30-40% of your income now goes to interest to other people after the taxes. That's a lot of money going to other people. And that's just because we're not disciplined, buying the right things. And the market and everything's expensive, so we have to get loans. But there's ways you can minimize paying interest to other people and save more money as well, which is a whole different concept. But I think after tax, it's interest.
Yeah, I don't disagree. I think on everyone's mortgage, you said it perfectly. If you know and you've seen, right, in these amortization charts, majority of your money, especially in the first 10 to 15 years, is going to interest. And most people move every 7 years. Every 5 to 7 years, people move. So therefore, for 5 to 7 years, you're paying majority of your money to interest. So taxes and interest, how to decrease paying so much in interest, and also how to decrease paying so much in taxes. So let's just talk about a couple things from a tax perspective.
Sure.
Now, we're not CPAs, we're not attorneys, but I would say that I know from my perspective, and I also know from Carson's perspective, we have professionals, individuals that advise us and help us and give us kind of just different tricks that we can do to try to eliminate, or probably better said, reduce our taxes. So obviously, a mortgage is one of those things. So one of the ways to decrease your taxes that you pay is paying some interest on a mortgage.
Yeah.
So owning a home, I think, is always a good idea. Owning a home it gives you a good tax write-off from an interest perspective, because that interest is a credit on your tax return. So if you're renting, try to buy, because usually the difference between a few $100s a month, even in today's interest rates, will make a big difference. The other thing I'll say in preparation for 2026 is, if you know that you're in the middle class or any class, because all taxes are going to go up in 2026 unless the administration completely changes and things stay into place.
Yeah.
But let's just assume it's not. If that's the case, I think one of the better things in preparing for the future would also be to understanding what money that you can put away now and what money you can convert potentially into Roth accounts. Because a lot of people ask me about, when should I convert my money from a traditional IRA to a Roth IRA?
Yeah.
If you know your tax brackets are going to go up in 2026, one of the best things you can do now is understand and get any kind of tax credits you can over the next 24 months, frankly. And with those tax credits, convert a part of or all of or as much of your retirement account into a Roth account. Get those taxes paid for, hopefully with tax credits from write-offs that you have. That will then in turn allow you to then compound and grow much quicker, because now you've paid those taxes, and it doesn't matter what the tax bracket is. So I think that's one key element, I think, is understanding your retirement plan, what kind of retirement plan you currently have, and talking to your CPA about what's the right time to convert a portion of or all of those assets from a traditional or SEP or simple kind of retirement account into a Roth account. Because look, tax brackets are going up. We all know it. Even regardless of probably a change of administration, at some point it's got to go up with all the debt that our government's taking on. So I think that's one of the key components of a tax, of preparing for taxes. The other thing I would say is, just to be timely about this, is go talk to your CPA. I think that's probably the best advice that I could give you, because I think most individuals, and this included myself for many years, probably a decade, where I'd only meet with my CPA once a year. And I would say that was probably one of the biggest mistakes that I made. I think meeting with your CPA and going over in preparing for the future, rather than just looking at the back, your past and what you need to pay, is going to be your best kind of ingredient in best way to defend yourself from tax liability. So you should be meeting with your tax professional. He's not going to, or she's not going to contact you every quarter to meet with you. I recommend at least 3 times a year. Meeting with your CPA at least 3 times a year, you're going to be then ahead of the game. You can talk about new purchases coming up in the next 3 or 4 months.
Yeah.
How to purchase them, when to purchase them. Should you put them on a credit card? Should you get debt for them? What kind of debt is good? What kind of debt is bad? Which debt can you write off and which can you not?
Yeah.
Meeting with your tax professional is a game changer. And if that little game changer allows you to get from a 39% tax bracket down to a 35 or a 30%, let's just say a 5%. 5% on $1 million is $50,000 in savings. If you just put that $50,000 into an investment at 10%, nothing crazy, or even 8%, but every single year for 5, 10, 15 years, $50,000 every single year compounded at 8 to 10%, we're talking about millions of dollars just by being aware of your tax liabilities and being proactive rather than reactive. So my advice to you right now, based upon what's going to happen in the next 24 months, is think ahead.
Yeah.
Meet with your CPA. Get the right kind of debts that are out there, so you are in a good place, so these new tax bracket and changes don't kind of beat you up too much.
I also think that you've mentioned a tax professional the whole time, which I agree with. But I would tell you too, like, CPAs work for the government. I don't think they work for you. Their license is on the line when they file your taxes for you. They want to make sure you are completely safe and nothing is even in question. They're not going to help you plan to buy certain things or do the certain investments to get rid of debt. They work within the IRS's limits. So I think you should have a tax strategist and a tax filer or planner. I think they're 2 different people you work with. if you just go to your CPA, most CPAs don't know how to buy real estate. They don't know how to help you do these things to help you decrease taxes. They'll just tell you put more money in a 401k, depending on who you're working with. So I say this because not everyone has a great tax professional like we do. Not everyone's going to help you do these things or strategize how to do this. You need to find the right people to do this with you, because they might just tell you the very simple 1 or 2 tricks to do that'll help you decrease a little bit, but they're not really going to help you plan these things out. So you have to work with the right people.
So I'm curious why you say that. I feel like you've met a tax strategist.
Yeah.
And so that's why you're saying that.
Yeah.
And I say that because I feel like you mentioned this individual you've met with a couple times or talked to, who's actually been very proactive and helpful for you. I would say I'll slightly disagree with you, but I also agree with you from one perspective. Not all CPAs are built the same way.
Yeah.
And so I do think that a lot of CPAs, that you are the client no matter what. They are there to serve you. And it is still up for you to decide which expenses are real business expenses and which are not. Some CPAs don't even look at that or don't even ask too many questions about it. You need to find a strategist or a CPA that is willing to actually help you make the right decisions. Now, I'm not talking about tax evasion. I'm talking about tax avoidance or tax deferment.
Or not overpaying.
Yeah, I do think there's some that are a little bit more aggressive, but I think if you can find the right individuals, and Carson, he told me about a strategist that's working with him and a CPA. I'm all for it. I think, even if you pay this tax strategist $10,000 a year, and your CPA, whatever you pay your CPA, probably $5,000 a year, but they're able to help you save 30 or 40 grand or 50 grand a year, it's a no-brainer. It makes absolute sense. And so this is what, and I think one important thing is, you can see, like Carson doesn't work for me. Carson's gone on his own journey, which I love. And he's also got some of his own help and his own team and relationships. The point of this is also for you to see that we have different ways of finding success, even from a tax perspective. So I don't disagree. I'm excited to see how it goes, because I might say, hey, look, I want to have your strategist help me with my CPA. So far, I'm pretty comfortable with my CPA and what he's doing. And I do feel like he works for me. And I do go to him. Like, for example, when I have a big expense coming up, I almost always call him first. How should I expense this? Is it a business expense? Here's what I'm doing with those things. Anything that's kind of major, when I say major, typically $10,000 or more, I want to know. And these are the kinds of things that you should be asking, because these expenses, if you have a business, a side hustle, you can have a business. And by having a business and allocating expenses towards that business can really decrease your income and bring you in the right tax bracket that will save you 5, 10, or maybe even 15% on your tax returns.
I love it. And we've talked a lot about taxes. Anything else you want to hit before we talk about interest?
Well, let's talk about interest now. Let's talk about interest. Go ahead.
Because it's a little bit different. Taxes we have to pay. You don't have to pay interest. Interest is a little bit different. We do, because we need to leverage debt in certain ways, but there's good debt and there's bad debt, like you mentioned. And there's ways to use this interest to help with taxes. So they kind of go together. But so when it comes to interest, there's a lot of ways you can go down this rabbit hole, because when you look at a mortgage, for example, and like we talked about, interest is front-loaded in the first 5 to 7 years of the mortgage, because banks know you're going to move in 5 to 7 years. They're going to front-load the interest, so you pay all the interest. If you look at your payment, 80% of the payment's going to interest, right? Most of the time for the first few years. When you get a 3% interest rate mortgage or a 4% interest rate mortgage, you're stoked. Who cares? The interest rate, honestly, in my opinion, doesn't matter that much, because you're still going to pay all the interest in the first 5 to 7 years, and then you're going to move and do it again. So it doesn't really matter a ton. Maybe your payment's a few $100 different, but it's not going to change majorly. And there's ways to, we can dive down IBC if you want, but there's ways to have a private system where you're out of the banks and you're able to get loans from your own bank and finance things your own way to pay less interest or pay interest back to yourself instead of others. And you can do that on a super, super small scale or a really large scale with like in a mortgage, because it's an easy example. But when it comes to private banking, that's a whole different concept we can dive into too.
Well, dive as far as you'd like to. I mean, I think if you're going to talk about private banking, I mean, you can give a brief summary, because I know we've talked about it a lot.
Yeah.
It's something you spend a lot of your time on, but it's really about paying yourself and using your own bank or paying somebody else.
Yeah, and you can, so the whole concept is called infinite banking. It's a concept of becoming your own bank, financing things through your own banking system. And there's a certain machine you use to do this and to run your money through, and it's a whole life insurance policy. It's a specially designed whole life insurance policy that you run your money through and use this as a vehicle to finance and buy things you need throughout your life. But you can also do it with other things. Like you mentioned on a previous podcast, you can take a loan from a 401k, go buy a car, pay yourself back, and your whole 401k is still appreciating. That's a better way to buy a car than going to get a bank loan paying someone else's interest. Same thing with a whole life policy. You just put money in there, take a loan out, go buy a car, pay yourself back with interest. Now, wouldn't that be a more efficient way to spend your money? You're paying yourself interest instead of someone else. You're running your money somewhere that you control instead of forced to make a payment to someone else. And if you don't make the payment to someone else, they're going to steal the car from you or steal the mortgage or the house. So there's ways you can be more efficient with how you get loans too.
So I'm going to mention this a little bit because this is a whole podcast just alone. You've even talked about this a bit with IBC. What I get to share on the subject in general is I think the more that you understand, you meet with your tax CPA, professional, strategist, and understand what interest is good interest and what interest is bad interest.
Yeah.
I think you can slowly do the things that you and I talk about every day. So for example, a car. The interest that you pay in a car loan is not typically a tax write-off. So that would be a good loan that you should loan to yourself.
Yeah.
A mortgage is something where you get to write off interest.
And you would need $1 million to get the house.
So it's more acceptable to go borrow money from a bank and get that kind of debt.
Yep.
But when you have debt that you cannot write off, I think one of the best things you can be doing is using an infinite banking policy or a loan from your 401k.
Or a loan from your brokerage account, anything really.
Because now you're paying yourself back. So interest that you can't write off, you should try to leverage it. And here's the problem that I see when people first hear about it, and frankly, when I first heard about IBC and also with 401k, people love the concept. They like the idea. This sounds great, but guess what? I don't have that much money. I only can put away $5,000. I think that's where people stumble and they lose probably interest in IBC or even a 401k because they think my account's not big enough.
Yeah.
Here's what I'll say to you about that is if you have that mentality, it's never going to be good enough. You're never going to set up an IBC or a 401k. The mentality you should have is I'm going to start the system. I'm going to start paying myself the interest. I'm going to start being my bank on small things. Start small. Put away $5,000 and use that for some kind of small loan. You're going to need it for something. So use that on a small, it could be a small car, it could be a small, whatever it is, something that's maybe not a tax write-off. Do that first. Same with the 401k. But I think if you start with understanding your taxes, and being proactive about it and saving 5, 10, or 15% on taxes every year, which potentially is $5, $10, $15,000 a year in taxes or more, maybe hundreds of thousands, and then moving that money into a retirement account in an IBC account where you can now leverage your funds to start doing what we're talking about, even if you do it on a small level.
Well, I like that you bring this up because when it comes to what kills people from building wealth, is first, these things. Most of your money is going to go to taxes and interest. You're not going to have a lot left over. Then what's left over, it's going to go through volatility, inflation, and it's going to be very hard to build wealth with it. To make it even harder, and to get to what we're talking about now is the mindset behind it all. If you just follow the status quo, you don't ever want to look at your money, you don't care about a 401k, you're not going to be disciplined to manage these things or want to improve, it's never going to work. So adding all of that, the fear and life that gets in the way on top of the problems with the actual money behind it, it just makes it very, very difficult for people to actually build wealth. And that's why most people don't retire at 65. Most people don't retire secure. Like it's because they have so many things coming against them and it's hard to get past it. So I feel like first you got to fix your mindset. If you can fix your mindset first, understand, like you just said, starting small is better than doing nothing, and putting money aside. And then whatever strategy you want to do, great. But at least you're getting into something. It's only going to get better. And you're actually setting yourself up to have some sort of actual financial success, but you have to start with the mindset.
I love that. Look, I'm going to piggyback on that and saying, you are 100% right. And I'll also say, those that are listening today, we're here. You're here, you're listening to this. Wherever you might be, at the gym, in the car, whatever the case is, everyone else who's not here is not listening. They're in the other room. They're the ones that they're going to keep doing what they've been doing. They're going to do what their parents told them, and or they didn't believe or dream in what they could actually become or achieve.
And that's most people.
That is most people, and you're not that. You're listening here to us, and you're trying to be a better and more knowledgeable person. And so I would say, as far as steps and the purpose of today's message is first to understand your taxes, understand what you're paying, how it works, how to avoid or defer it or bring it down. And then number two, next thing would be how to understand interest. What's good interest? What's bad interest? Those little things are going to save you tens of thousands of dollars. And then if you decide to put half of or all of those savings into something that bears an 8 to 10% interest rate, compounded over years, we're talking about millions of dollars. So that's our recommendation today. And so is there any kind of final thoughts you might have on this subject?
I think we hit it on the head. I like the idea of different types of interest. We didn't dive in too deep into it, but there's difference with it when it comes to compounding interest versus depreciating interest, simple interest, amortized interest. So go do your research, guys. This is just your first step to learning about these concepts. Go now dive deeper and keep watching our podcast, keep learning from us, because we're going to keep putting out content to keep feeding you guys what you want to hear. So with that being said, we always end with something we love as a family, doing what we call sweet, sour, and service. Basically end by saying, hey, what's a sweet of our day or week, sour, and something we did to serve someone else. So we always end with this. You want to go first?
Yeah, sure. And I'll say one more thing too. What lit this conversation is something that is real, that came up in the news, that come 2026, tax brackets are going up. The laws are changing. Prepare yourself. Don't wait till 2026. If there's things that we're telling you right now that you can be aware of to defer or change or meet with your CPA to see what you can do in your own situation. So come 2026, you don't pay more in taxes then. So think about that. So look, my takeaway as far as my service and I'd say my service is. This morning I was able to help Jess so she could go and do her routine, and we had a great time, Summer and I. So Summer and I went on a long walk, and I had her for a couple hours. It was great. I think that was a service to her to give her alone time. I think everyone needs that in the morning. So sometimes we have some help, and sometimes we don't. Today we didn't, so that was probably a service, even though it was really fun. So I almost feel like it's a cheat. My suite this last week was my birthday, and so I got really awesome, fun messages, and was able to celebrate with Jess and some friends, and get some beautiful messages, including a surprise message from Miley, my daughter, who's on a mission. Really sweet message from her. So that was a nice, sweet. Oh, my sours, I feel like I've been a little under the weather, but not a big deal. Live in a great place and all as well. So those are my three.
Yeah, and I'll wrap up quickly. But we have sweet was being able to surf this past weekend. It was big. It was fun. It was great. I haven't surfed in a while on big waves. That was so fun. Sour is. I had to fly to Vegas and back yesterday, traveling 6 a.m. flight, 9 p.m. home flight. It's just a long day. So that was not my favorite, but it was good to be in Vegas. And service was going to Vegas. I didn't have to go, but I went to meet with one of my partners, and he wanted to be in person. I figured we could just do something over the phone or Zoom, but it was good to be in person for him, and it felt good. So it all came together. But we're grateful for you guys listening, a part of our journeys. And we're hoping to be, pieces and advice for you guys' journeys too. So thanks for listening.
Thanks.